We are all aware of how exceptional Mohnish Pabrai is at sharing his investing wisdom. In this video, we have curated some of his best insights on investing. We hope you find it valuable for your wealth creation journey. To make it easier for you, we have also marked the chapters so you can navigate through them effortlessly.
Yeah, I think many times in life we are confronted with exactly these types of odds where if you go for something, it could be a winner, and the downside is very limited. From taking a random meeting with a stranger to a variety of other things that you might engage with. I think Michael Jordan said you miss all the shots that you don't take. So basically sometimes going for a few things, even if it's not a 100% sure bet, can work out really well in life. And I think one of the misnomers that people have about entrepreneurs is that they think entrepreneurs are risk takers. And actually the reality is the complete opposite. So if I look at startups, and I would put startups into two different categories: venture-backed startups and non-venture-backed startups. Non-venture-backed startups make up 99.999% of all startups. And venture-backed startups actually are the anomaly. So I'm not talking about venture-backed startups. We can ignore those startups. But non-venture-backed startups basically tend to have entrepreneurs who tend to, even though they don't think about it in this format explicitly, they do everything in their power to minimize risk. And I gave the example in my book that, let's say there's a barber in a small town, and he has a barber shop, and he's got customers, and he's kind of doing okay. But there's just about as many barbers as are needed in that town. So no one just does extraordinarily well, but everyone does okay. The barber notices that there's a new town emerging about 10 or 15 miles away. And he goes out there and he sees that, there's some growth happening, people moving in, etc. And that there are no barbershops in that place because it's brand new. And so what he does is he basically, sublets a small space, puts in a chair, and decides to spend 1 or 2 days a week, starts with 1 day a week, at the emerging town. And because he's the only game in town, he can charge more for a haircut. And the opportunity cost for the people who live in that town is that they would have to travel 10 or 15 miles for another barber. And so they're willing to pay a little bit more just for the convenience. And so he goes out there once a week. And since he's the only game in town, and hair grows and people need their follicle trims and so on, and business picks up, takes off. And he's doing better than average. He's making more in 1 day there than he does 1 day in the town with a lot of barbers. So he bumps that up to 2 days. Basically he starts spending more time there. And that is the way entrepreneurs go about it. So if you think about what is the risk that barber is taking by stepping into this new town, well, he subleases some very small space. He probably buys some used equipment. He doesn't really have any payroll or anything. He's just going kind of himself. And, he might for a few days not have 100% load. So he might lose some business that he would have had in the other place. But the whole risk profile is extremely muted. It's very low. On the other hand, if this town booms, he could eventually be full-time in the new town. He might even be able to hire other barbers to work at his shop. And now he has, at least temporarily, supernormal profits. And so basically, this is kind of classically how a lot of entrepreneurs goes about it. This is the way the Patels went about. The Patels came to the US as refugees. They were thrown out of Uganda by Idi Amin. They had been there for 100 years, And so Idi Amin said that Africa is for Africans. These guys were Africans, basically. They weren't black, but they had been there for several generations. And they became stateless because he threw them out, and they dominated the Ugandan economy because of their, great approach to doing business. And the UK took some of them in as refugees. Canada took some of them, and the US took some of them. And they basically, all their assets were nationalized. So they lost almost everything. And they were able to convert a few of their assets into gold and get it out of the country. But when they came into the US, they didn't really have too many skills that would have been in high demand in the US. And the motel business looked very attractive because they could live in one or two rooms of a small motel. A bank would finance 70, 80, 90% of it. And they could employ the entire family into motels are labor intensive, into doing all the different, tasks needed for the motel, the housekeeping and front desk and so on. And what happened is the Patels basically accidentally didn't really set out to do this. They became low-cost providers because they had no workers' comp or payroll or anything. And because they were the low-cost provider in a particular area, they could look at what other motels were charging in the area and charge 10 or 15% less and still have the same profitability of everybody else. But when they charged 10 or 15% less, their occupancy went to nearly 100%. And so they had supernormal profits relative to the other motel owners. And this very small group of refugees that came in, I mean, I would say Patels in the US are in the tens of thousands today. They're not in the hundreds of thousands. Maybe they might be 100 or 200,000. But if you look at the US population of 330, 340 million, they're not even 1/10 of 1% of US population. Today, they own north of 50% of all motels in the country. When you're at a motel somewhere, you may not realize it, but you're at a Patel motel. And they've moved upscale into the Marriotts and the Hiltons and all of that. So so amongst the motels, the lower end motels, they have 50, 60% ownership. But even at the higher end ones, they're creeping up on the 15, 20, 25% of those. And it all worked just the way the barbershop worked, except in their case, what happened is, so entrepreneurs start off as arbitrage players. That's really what they're doing. They're arbitrage players. The barber is the classic example of an arbitrage player. And what happens is that over time in that new town, that barbershop's supernormal profits will not last. More barbers are going to come into that town. And eventually all those extra profits and higher prices that he charges usually will get eroded away. Now, what may happen, sometimes what happens in business is he's a talented barber and people get used to it. We are kind of creatures of habit and they like him. And if he's very talented, they might be willing to pay him 10, 15% more than anyone else, just because even though there are other barbers available, they now have a habit of coming to him and so on. So sometimes what should be a non-durable competitive advantage ends up becoming a competitive advantage by accident. And that's the same thing that happened with the Patels. What should have been a non-durable advantage actually became a sustaining advantage over a 50-year period. They just, took over that industry. And we see this over and over. So this heads I win, tails I don't lose much is actually the way almost all non-venture backed businesses get started. If you look at a small mom and pop Chinese restaurant that opens, they go through the exact same calculus. They look at, okay, I'm looking at Cambridge. Do they have an oversupply or undersupply of Chinese restaurants? Oh, there are too many Chinese restaurants in Cambridge. Let's forget about that idea. How about going, 70 miles away from Cambridge? What's the situation there? And there you might find a town with pathetic Chinese food, and these guys are talented chefs, and they might make it happen. And that again, non-durable competitive advantage, if they're talented and they get a following, may become sustaining over time. And that's the way capitalism works. And uh, that framework also is applicable in investing. I mean, the important thing in value investing, as practiced by Warren Buffett and Charlie Munger and so on, the very first thing is downside protection. We don't even look at upside until we first look at the downside. And it's just like the barber. The barber doesn't want to lose his shirt when he opens this new place. He's not going to go sign some fancy lease on some big space and put all his savings into that new thing. He's going to scrounge to keep the risk down. And if he does the fancy place with all the razzmatazz, he will be out of business really soon. And that'll be the end of the barber and all of that. So the entrepreneurs that make it, they are arbitrage players. They focus on the downside. And we as investors and value investors, we do the exact same thing. Whenever I'm looking at an investment, what we want is we're looking for free lunches. We want the downside to be zero or as close to zero as we can get with a massive upside. And because we function in auction-driven markets, and because auction-driven markets have a tendency to overshoot or undershoot, things get either too richly priced or too pathetically priced. The richly priced we can leave aside. Don't need to go buy Nokia. That's fine. I mean, sorry, don't need to buy Nvidia, but you can look at things which are hated and unloved. And there's always things that are hated and unloved. And when you get things that are hated and unloved, you can get mispricing in the right direction. And if 7 moons line up where once in a while some great business is hated and unloved for temporary reasons or some temporary issue, and then that can lead to a good result. So that's what we try to do.
Yeah, I mean, I think Apple is I have a very good friend of mine who's a venture capitalist in Silicon Valley. And right after the first iPhone came out, he called me and we had a long conversation. And he's an investor in my fund. And he told me that I needed to buy Apple in Pabrai funds. This was, I think, in 2007. And he told me and tried to explain to me the App Store and what that meant and kind of where this was going with the App Store and the ecosystem. And he also tried to explain to me, actually, it was one of the most eloquent discussions I had with anyone about why to invest in Apple. And he highlighted the moat, but he also highlighted the fact that one of the things, put a pretty powerful computer in each of our palms, and he thought that was a very significant game changer. And this was in 2007. It was well before Uber came out. It was well before a lot of other companies came out, and a lot of these companies could not exist if the iPhone did not exist. I mean, you just wouldn't have Uber if you didn't have an iPhone. It's just not possible to do it without a smartphone. And so it basically became the infrastructure on which everything got built. But I'm one of these stupid people that when people hit me with a 2x4 in my head with a great idea, I'm still not able to see it. And somehow we still limp along and do okay. And Arvind still wants me to talk to you guys. So I looked at Apple at the time. It wasn't at a single digit PE. The moment something's not a single digit PE, I'm gone. You already lost me. The moment you get to something at 11 times earnings or something, I'm lost. So clearly, I did not appreciate. I mean, I understood what he was saying, but I didn't want to pay up. I wanted a lot cheaper price to get a business like that. But even then, I've always been skeptical. And even today, if you look at Apple today, forget 2007, let's look at 2016. So Apple trades at a pretty modest multiple. If you look at their earnings stream versus the market cap, it's very different from Amazon and Facebook. I mean, it actually produces massive earnings, and it's trading at less than, after you take out the cash, I don't know, I think less than 12 or 13 times earnings. I think Arvind may have the exact number. And that's not a high multiple for a business like that. But, I also play back in my head the graveyard of companies in technology like BlackBerry and Nokia and all these other ones that have had huge runs and disappeared. And Apple has something more than those companies have, because they have the App Store and they have habits. The important thing, this is what my friend in 2007 was saying, Mohnish, human habits are changing with the iPhone. And you have to understand when the habits change, that is very enduring. It was a great talk. I wish I had recorded that talk, because if I could play it for you, it'd be better than me babbling here. And so he was telling me about the habit economy, and all these habits were very important. And I didn't appreciate that. And so today we have a situation where Apple's, I think, unit sales are dropping, but their earnings are still rising. And because the ecosystem just gets larger, there's over 1 billion devices which have apps on them. And every quarter, the number of devices that have apps on them increases, even if their quarter-over-quarter sales decline. And of course, they got a free tailwind from the woes of Samsung, if you will. But my take is that this is one of those things where you want absolute no-brainers, and anytime in the investing world you have doubts in your head, then you're better off just not going there. So, for example, for me, drilling into the shipping company half off is a lot more tangible to get comfort than I could get with Apple at 12 times earnings today. It's just, and that may be a mistake, but it's just the way I'm wired. And so someone else can hopefully figure that out and do better with it.
In the world of investing, stock valuation is a fundamental concept used to determine the fair value of a company's shares. Investors rely on various metrics such as price to earning ratio, price to book ratio, and discounted cash flow analysis to assess whether a stock is overvalued, undervalued, or fairly valued. However, there are instances where traditional valuation metrics take a backseat, and the prospects of a business become a primary driving force behind investment decisions. This phenomenon occurs when the growth potential and the future outlook of a company are so promising that they overshadow current valuation concerns. Mohnish spoke about his experience with Apple stock, but there are plenty of such instances when investors have missed the boat. Tesla is another example where traditional valuation metrics fail to capture the company's potential. For years, Tesla traded at a premium, despite skepticism about its ability to achieve profitability. Investors who recognized Tesla's potential to revolutionize the automotive industry with the electric vehicles and autonomous driving technology were rewarded as the company scaled production and achieved profitability. Another example being Amazon stock. In the late 1990s and early 2000s, Amazon was often criticized for its lack of profitability and high valuation multiples. However, its relentless focus on customer satisfaction, continuous innovation, and strategic investment in infrastructure and technology allowed it to dominate e-commerce space. Today, Amazon's valuation is supported by its vast market presence, diverse business lines, and consistent profitability. While stock valuation remains a crucial aspect of investing, there are times when the prospects of a business can justify high stock prices, such as disruptive innovation, scalability and network effects, market leadership and brand strength, future profitability, and market expansion are the factors that can lead investors to prioritize growth potential over current valuation metrics. Successful investors often balance the art and science of investing, recognizing the exceptional businesses with strong future prospects that can deliver substantial returns even if their current valuation appears stretched.
And of course, since that time, my venture friend sprinkles salt on wounds and reminds me what his Apple position is worth versus what his Pabrai fund's position is worth.
Warren Buffett has said that he wants to buy businesses that are going to return on capital employed for a very long time. How do you know if a business is able to employ capital at high rates of return over long periods of time?
It's a great question. And, Munger would say, why should it be easy to get rich? So that the ability to answer that question has the possibilities to make you insanely wealthy if you know how to answer that properly. And it's not easy to answer that properly. So let's take a business like Geico. Geico is a direct writer of auto insurance, unlike State Farm. If I buy a policy through State Farm pays 10% or so of that premium to the agent who, independently owned agent, which is bring that policy in. Geico uses a call center. And so it has approximately maybe, 8, 10, 12% advantage over State Farm and Allstate. And that's a secular advantage. And that advantage has allowed Geico to go from nothing to, it used to be 2-3% of the auto market. Now it's 8, 10, 12%, and they're continuing to grow. But Progressive, which is also a direct writer of policies, has run circles around Geico. So Progressive invested very early in telemetry technology, which gave them a lot more data about how the cars were being driven by these drivers. And that allowed them to have a much better understanding of the risk. So they were willing to, they knew that certain drivers, you could offer even lower premiums than Geico, bring them in, and they'd still be profitable. Whereas Geico would look at the driver and say, I really can't take this guy below a certain premium because they were missing some data points. So that's an example of how, and Berkshire's now trying to fix that. They're behind the 8 ball trying to help Geico catch up to Progressive. My 2 cents is that Progressive is really good at technology. And they've had a long head start. And they're continuing to jam on this. So I think Geico's going to have a hard time. They might get there, 5 years, 10 years, they might get there. They still have the advantage against the other player, but they're not the best. They were the best 10 years ago. They're not the best today. And so one would not have been able to predict 10 or 15 years ago that we'd have this kind of issue come up with Geico, right? We just look at Geico and say, Berkshire Hathaway, they've got this advantage. They just keep chewing through and getting more market share. They've got great customer service. Who doesn't like the gecko? On and on. And you guys might not remember this, but there were these series of ads Geico had for the caveman. Do you remember the caveman ads? So the caveman ads were hot and heavy when we met Warren for lunch. So my daughter asked Warren, have you met the caveman? Okay. And Warren said, I'm sorry, I haven't met the caveman. Can you tell the caveman we really like him? It's so funny. Anyway, so, I think that this, or if you look at Coke and the sugar issue, and where does that go 10, 20, 30 years from now? Is it an issue? Is it a non-issue? Is most of their portfolio non-sugar, carbonated versus non-carbonated, whatever. So I think that if you look at Visa and MasterCard, incredible businesses. What do those businesses look like 10 or 20, 30 years from now? There's so much happening in payments. American Express, so much happening in payments. It may not be easy to figure those things out. So this question, we can clearly tell which businesses generate high returns on employed capital. That's black and white. It's in the balance sheet. We can tell income statement. It's easy. The nature of how long that can continue becomes a much harder question. And that's why we want a margin of safety. And that's why we want these aha moments. But if we can figure that out, in some cases, I'll give you an example, which is going on right now in my portfolio. I'll talk a little bit about one of the portfolio holdings. There's a company in India that I invested in about 3 years ago called Indian Energy Exchange. It is a network effects business that basically has 98% market share, where electricity on the spot market is bought and sold through their servers. And whatever is bought and sold through their servers, they keep 1% of the transacted amount. When I first invested in the business, there's a company called American Tower. And American Tower basically owns, tens of thousands of these cell phone towers. And it's a great business because by the time you get the second tenant on that tower, anything incremental coming in is almost 100% margin. And then when you go from 3G to 4G to 5G, each one of those is adding more complexity and such. And once AT&T architects its network and has towers in certain positions, if you take out one tower, it affects what I'm saying is that you can't take out one tower and put another one a mile away. It affects the whole network. So in effect, the owner of that tower has a advantage where AT&T is probably going to keep paying rent well beyond the lease term because their network topography would change so much if they had to redo these things every time. So for a number of reasons, American Tower is an incredibly great business, and it's been a great business for a very long time. One of my friends used to be a fund manager at a large fund house, and they had an investment in American Tower, and they went. They had an investor day, so they invited all these fund managers to their headquarters, and they were going to have some meetings and presentations, and then play golf in the afternoon. So my friend showed up a little bit early, and he went to the CFO's office. He knew the CFO, and he saw the CFO just sitting there with his feet on his desk. So he asked him, "Hey, you don't look like you got anything to do." He said, "Yeah, I don't have much to do." He says, "Don't you need to do deals? You guys keep buying new towers. Don't you need to do new tower deals?" So just sitting with your feet on it. He said, "Look, everyone has my number. Anyone who has a tower for sale, they know how to reach me. And they also know exactly what I'm going to pay." He said, "There's no voodoo or work involved. The call comes in. We tell them, yes, here's the terms. Here's where you sign. We wire the money. We move on. My feet are still on my desk." Okay. I don't need to go have a root canal about this. That's the definition of a great business. Okay. And when you look at something like American Tower, it's likely that's going to endure for a long period of time. Now, there could be a disruptor. Elon could put everything in satellites, for example. Okay. And at that point, he's not going to have his feet on this desk. His feet are going to be shaking, okay, under the desk. But who knows how far that is and what the odds are and whatever else. And so I think that when I look at a business like IEX that we invested in, it was about 3% of India's electricity was flowing through their servers when we invested 3 years ago. Now it is north of 7%. It's become 7.5%. It's grown a lot. And India's per capita usage of electricity is going up as well. And the government announced some policy changes where it's probably going to get to 20 to 25% of the total electricity. It might even go higher, might be 30, 35%. It's huge to take a country the size of India where the per capita electricity usage is so small, and then you collect. And the way that business works, 75% of revenue is net income. Okay. When I visited their offices, in New Delhi a few times. It reminded me of Chuck Akery and my friend with American Tower. I saw this country club, relaxed place. Nobody's really stressed. They got about 40 software guys who don't seem to have much to do. And they got 30, 40 other people who also don't seem to have much to do. Everything's running through 2 or 3 servers they have. And the money is flowing, everyone pays them in advance. They have no bad debts, nothing. And whatever comes in, they have no expenses. Okay. It's a bunch of, bits running around on a server, and they collect 1%. They've got no expenses. They just pay for the software people. So as their revenue grows, this 80-person company might become If it becomes 10 times the size in revenue, it might go to 120 people, 50% increase in people for 10x the revenue, and the 72% might become 82%. Okay. So now the question is, how long can this continue? Okay. I don't know. We've had so far 5x or 6x return since we invested. Well done, Mohnish. Like I said, we don't learn nothing. IEX teaches us nothing. Okay. It just feels good. Okay. But I don't know how long it can go on. It could go on for 20 years. Okay. If it goes on for 20 years, hallelujah. God loves me. It could go on. It might also maybe like in 3 years, some policy changes come in and something happens or whatever, upsets the apple cart. We don't know. It's some of these things are kind of hard to figure out, but my best guess is let it ride. So we have a India fund where IEX is now like 40% of the pie. And we're like saying, it's okay. We just keep our investors informed. And I said at 95%, when it gets to 95%, which it might, the way it's going, as long as we can just let everyone know, listen, guys, 95% of your money is in one stock, and disclose that properly. If you don't like this, you can exit or whatever else. I think we're okay. But you don't get many opportunities like that. And I made a mistake with IEX. I used to own 5% of the business, which was the most we could buy. And then COVID hit and I was concerned. It always looked expensive. That's the thing. When you look at Fair Isaac, like if I look at IEX today, trailing earnings, it might be trading at 80 or 100 times earnings. Okay. Because it's a spectacular business that's growing like crazy, so it's never going to be at 8 times earnings. So anyway, I think that question is a great question, and it's a great question to think about. And you only need to figure it out once. You only need to find one IEX or one American Tower. And if you're right about that runway for 30 or 40 years, just sit there and let it rip. And you're done. That's it.
Well, I think that I used to run Pabrai funds with a very simple model that if we'd make a bet, we'd make it 10% of assets. Kind of a 10 stock portfolio, 10, 12 stocks made kind of sense to me. And what I found is that during the financial crisis, we were finding lots of companies where there were kind of entire classes of businesses that were really cheap. And we could get some diversification by buying a basket. And I also found sometimes it was better to not always do 10. Sometimes a smaller bet was justified. So now what I do is I'll either do a 2% or a 5% or a 10% bet, just depending on what it looks like. So if we get to the point where you're seeing very high discounts to underlying value, at the same time very low probability of a loss, then you can step up, and otherwise you can pull back. But I would say that the less bets the better, and the more you know about the business, and the greater the conviction, the better. So Jeff is in the real estate business. He does very well, and specifically in single-family homes, renting and flipping, both. And so the thing is, if you ask someone like Jeff, you might question what he's doing because everything is in one asset class. It's in almost one geography, maybe a couple of geographies. And so you might say there's a lot of concentration there, but at the same time, the degree of knowledge is very deep, and I sense they know what they're doing. So in fact, looking at the two of us, I would think that I'm maybe too diversified, and you might actually have it right because you're very close to what you're doing, and you know what you're doing, and you've been in that space for a long time. So there's a lot to be said for the depth of knowledge and such.
So all my data sources are open because I am a very lazy investor. I never meet management. I never talk to management. I never travel to see any plants or anything. I've never done that for any investments. And the results still work out. Um, so we're not looking for superior information. What we're looking for is superior analytics on commonly known information. So for example, I mentioned the boom and bust of the shipping industry. And the gentleman asked me about, is that going to change? Well, number one, it's never going to change because we have humans involved, and humans are hosed on the emotions. And the second is that market participants, we have two advantages against market participants. One is we have analytics, which can help us because we have some understandings that maybe markets are missing. And the second is that we have patience. So most investors don't have multi-year horizons. They want, I want to buy a stock at 10 and 2 weeks later I want to sell it at 12, and then I want to buy something else at 12 and sell it at 15, and I want to keep doing that. Well, good luck. If that worked, they'd be Warren Buffett because the compounding rate would blow away Buffett's compounding rate. But clearly, we still have Warren Buffett in place. So therefore, that approach doesn't work. And so if you have the patience and if you have the interest to really dig deep, then what you're going to find is that with commonly held information or known information, you may come up with insights that others have not. So, this is what Charlie Munger talks about, the lattice work of mental models, is you look at things through a different lens to try to see what can be different. Like I would say that when my friend Guy Spear uses the mental model saying that if Moody's is a great business in the US, what other businesses are like that in the other parts of the world? That's a great model because you may be able to find a business in another part of the world where people have not realized what a great business they have. And that's why these things get to where they are. And so, like, for example, I think all my life, or at least all my investing life, I hated the automobile industry because it's high capex, it's unionized, you got consumer tastes, and you got a lot of things which are not good about the business. But when I studied the business I spent about 6 weeks studying the business, I actually realized that many of my underlying assumptions were wrong. And that the reason the auto companies had problems were for different reasons than what people think they have problems. So I did not have access to any data that is not publicly known. But I just synthesized it from many different sources to come up with some insights, and those insights were helpful. So I think the thing is that if you are a curious person, and if you are a person who's very deeply interested in business and how business works, and understanding different business or industries, then you can do quite well.
Well, so let me take your unicorn question first. It's almost for sure that in that group, there are probably a few that will be outlier winners long term, and quite a few that may disappoint, is my best guess. But the thing is that depending on your frameworks and circle of competence and what you understand, like I'll give you an example. So let's take something like food delivery. Okay, so some of my friends who are very good investors, they just tell me this whole food delivery business is total nonsense. Okay, it's very heavy logistics business. You have to have people, you got to do all this point to point stuff, all this stuff going on. And the restaurants are all upset because they have to give you 30% and all of that. So there's a lot of issues there. But the thing is, if you fast forward maybe 10 or 20 years, the situation could be quite different. So we are going through I mean, you're not going through so much habit change in India. I think in the rest of the world, there's a much bigger habit change. Because in India, you always had the ability for some random restaurant to deliver your food at home. And so in the US, when I first came to the US, the only thing you could get delivered was pizza in terms of food. That was the only food delivery available. And now everything can be delivered to you. And, there are ventures like Cloud Kitchen and all of these things where they're working on the logistics, right? So there's one big warehouse, which has got like 30, 40 different kitchens, and then maybe a drive-through in the middle. And, the driver will maybe pick up 30 orders at one shot. And there'll be a very high density that, 3 buildings he's delivering all 30 orders and so on. So it could change quite radically in terms of scale in the years. And then at that point, brand matters and such. So it's possible that the top 2-3 food delivery guys in the end become incredible businesses, and they become a lot bigger than where they are today, and so on and so forth. What my take on all this is that there's no need to have envy or scratch your head or even try to say, I need to figure out which one over here. Things need to be at the end, they need to be a no-brainer. So when you're making an investment, in the end, before you make the investment, it has to be a no-brainer. Like I told you that even at 700 billion, I don't consider Tencent overvalued. And that's because I looked at all the pieces, what's inside those businesses and kind of where things are going and so on. And there's just too many ways for them to win and too few ways for them to lose. So anyway, so the thing is, I think that the bottom line is that, you can look at these unicorns. You can, in most cases, they won't make any sense. Once in a while, you might find something where you have some experience and the pricing or whatever else might make sense. And maybe it makes sense at that point. But if you can live a very good life and you can actually be a very successful investor without making any of those bets. So it's perfectly fine. There's 100 different ways to move on.
So my objective whenever I encounter any stocks is to, as quickly as possible, reject the idea so I can get back to general reading. So the model is not to find investments. The model is to find the flimsiest reason to say no. And as soon as I get to the first reason, I'm done and I move on. And usually 2 things work pretty well for getting rid of stocks really fast. The first is circle of competence. You encounter, if I look at some pharma company or something, it's gone. I don't even need to look beyond the name, it's gone. And the second is that if I think I have some understanding of the business, then the second is I look at very quickly the market cap, earnings, just some metrics on valuation, and I'm talking about less than 60 seconds. And once I see that it's not at a PE of 1, it's gone as well. So basically, we want to, or at least I want to, get rid of investment ideas for the flimsiest reasons as quickly as possible. And let's say some stock is really cheap. It appears to be within my circle of competence. Then for 1 minute, I'll go to 5 minutes. I'll give it 5 minutes. And again, to find something where I can just get rid of it. And if I cannot get rid of it in 5 minutes, then I'll give it 15 minutes. And all these exercises are designed to get rid of the stock as soon as possible. And the inversion of that is that I'm only looking for, if I can find 2 or 3 ideas in a year, I'm done. And I think in daily emails, which I get in my folder, I think on a typical day, there are like at least 3 or 4 stock tips,
in that folder. And within the 900 seconds of processing the folder is those 4 stock tips. Each of them gets 15 seconds, because I just look at the company, I look at the price, and I very quickly try to see, okay, what is this guy saying is the money we're going to make on it? And a lot of times the stocks I get, it's trading at 10 and it's worth 13. And then, there's a 40-page write-up explaining why it's 13. Well, once I see it's worth 10, I say, okay, I'm going to give this human full benefit of doubt. I'll accept that it's worth 13. And he didn't say it's worth 60 with it trading at 10. So we're done. Move on. And so that's how, so basically, be a very harsh grader on stocks. And the second thing about this business is, you guys don't play baseball, but I think maybe you're familiar enough with the game that Buffett says in investing, there are no called strikes. So, baseball, 3 strikes, you're out. In investing, you can let 1,000 balls go by, 10,000 balls go by. You can let 95% of great investment ideas go by, and it doesn't matter. So there's always more balls being pitched at you. And so if in a year you can find 3 of them, and even after finding 3 of them, if one of them is you're wrong on one of them, like one of the commandments says, that's just par for the course. It doesn't matter. If you're right 2 out of 3 times, you'll be quite wealthy. The scuttlebutt, or the amount of time it takes, or the due diligence to get comfortable with the investment, that varies quite widely. It's been as short as 3 hours from the time I first ever heard about a company to the time I started buying it, to 3 months, where, like I think when we made the investment in Fiat Chrysler in 2012, I hated that industry so much. I kept trying to find reasons not to invest. And after 3 months of digging, I capitulated and bought it. And it's been an 8x since then. So basically, the thing is, it varies. It just depends on the business. The good thing is that if you run a concentrated portfolio, and if you're going to make 2 or 3 investments in a year, you have more than enough time, especially if you're quick to say no and you don't spend time with other humans. You have more than enough time to basically do all the research you want to, even kick the tires as you want to, and so on. So that's the Buffett model. And I think many of the things you'll hear or you'll see with the way I operate, first of all of these were copied from Warren, so I didn't come up with any of these. But it is not the way the industry operates. And in my opinion, the industry operates stupidly. And so, many things, no team, no management fees, doing all your own work, concentrated portfolios, all of these things, this is the path to nirvana. And that's what you want to be getting to, and that's what you want to be doing. If we had a perfect crystal ball, and which told us what the risk-free rate of return is going to be for the next 20 years, then that would give you a basis to come up with a discount rate. That would be the right way to do it. But we don't have crystal balls that tell us that. And Charlie Munger also says that he's never ever seen Warren do a discounted cash flow. I already told you, thou shalt not use Excel. I know that in your time at LBS, you have never turned on Excel, and I'm so proud of you. So the thing is that we are not really going to fixate on stupid things like discount rates. What we want is obvious no-brainers hitting us over the head with, in the US, what we would call a 2x4. Something you'd buy at Home Depot. So basically, when I was looking at, let's say, Fiat Chrysler in 2012,
I've never run a DCF. I mean, I think DCFs are, for the birds. I mean, the market cap of the company was 5 billion, and I thought in maybe 5-6 years they'd make 5 billion a year. And I said, okay, why don't we just buy the company and hold it for 5 years, and let's see what Mr. Market will price this business at when it's making 5 billion a year. I'd really like to see it being priced at 5 billion then, and be the cheapest stock on the planet. And so that was the extent of the DCF that was done. And so basically what we're looking for is we're looking for very obvious no-brainers, wildly mispriced, severely undervalued opportunities. That's what we're looking for. And we want to be harsh graders and say no to everything else.
Normally, when I make investments in the fund, in fact, I've never invested more than 10% of assets in any one bet. Typically, ideally, it's kind of a 10 by 10 portfolio. There was a very good investor in India who passed away recently, Rakesh Jhunjhunwala, and he never managed money, outside money, and he had probably less than $500 to his name when he started his career. Didn't live that long, actually died in his early 60s. And when he passed away, his net worth was north of 6 or 7 billion. No fees. These are all, organic. And he didn't run companies. These are all, passive investments. Half that money was from one company. So he made a 4% bet a few decades ago in a company called Titan Industries in India, which ended up becoming more than half his portfolio. And Titan has done extremely well over the years, going to keep doing well. So if you think of someone like Rakesh's portfolio, let's say the other 96% of the portfolio went to zero. He just hung on to his Titan. Well, he still end up with like 3 billion or something, And so we start out, I would say, not that concentrated. But if the job is done right, you would end up very concentrated.
Mohnish Pabrai advocates for a concentrated stock portfolio, believing that focusing on a few high conviction investments can lead to superior returns, which he has mentioned multiple times, and his example of Rakesh Jhunjhunwala has been highly inspirational as well. Let's take this example and try to get influenced by this proven strategy. Rakesh Jhunjhunwala's investment in Titan Company is one of the most iconic and successful stories in the Indian stock market. Jhunjhunwala began investing in Titan in the early 2000s. His initial purchase was around Rs 3 per share. He saw the potential in the Titan's business model, which focused on watches, jewelry, and eyewear, sectors he believed had a potential growth prospects in India. Despite the market volatility and various challenges faced by the company, Jhunjhunwala maintained his position in the Titan for over 2 decades. His long-term conviction in the company's ability to grow and capture market share in the organized retail segment played a crucial role in his decision to hold on to his stocks. Over the years, Titan's business expanded significantly, and its stock price soared. By 2021, the stock price had reached over 1,500, marking an astronomical increase from Jhunjhunwala's initial investment. In 2021, Jhunjhunwala and his wife collectively owned around 4.87% of the Titan company, equating to approximately 43.6 million shares. Based on the year-end price in 2021, the value of their holdings in the Titan was approximately 10,466 crores, which is over $1.4 billion. In 2024, the value of Rakesh Jhunjhunwala's investment in Titan Company, which is managed by his wife after his death, stood at approximately 15,562.7 crores. On 3rd of May 2024, Titan Company declared a dividend of Rs 11 per share. The total dividend issued by the Jhunjhunwalas from the Titan Company in 2024 would be approximately 479.6 crores, which is 266 times higher than his initial investment in Titan. He initially bought approximately 6 crore shares of Titan Company. The stake in Titan became one of the biggest component of their portfolio, turning into Multibagger and contributing immensely to their wealth. But there's a twist. Jhunjhunwala's net worth was likely around 200 to 300 crores during the early 2000s. Based on his known investment activities and market reputation at that time, thus Rakesh Jhunjhunwala's initial investment in Titan Company likely represented between 0.6% to 0.9% of his net worth in the early 2000s. As detailed financial records from that period are not publicly available, we made a reasonable estimation based on available information. And now the Titan investment is around 35% of the portfolio. This investment strategy emphasizes deep research and significant stake in fewer companies. His investment in Titan was driven by his insights into the rising disposable income and changing consumer behavior in India, where there was a growing preference for branded products in jewelry and accessories. He believed that Titan's strong brand, extensive retail network, and product innovation would drive this growth. Titan is cited as a textbook example of power of long-term investing and conviction in a company's fundamentals. Jhunjhunwala's success with Titan has and will inspire many investors to adopt a similar approach, which is focusing on thorough research and holding on to high-quality stocks for the long term. Overall, Rakesh Jhunjhunwala's investment in Titan is a testament to his investment acumen, patience, and belief in the potential of Indian consumption-driven growth story.
So one of the things I always kind of scratch my head about is that, these very smart investors would buy MasterCard after the IPO. And, they might be more diversified than me. Maybe they might have 20 positions, which is fine, no problem. And so MasterCard is like a 5% position. And then it does really well and it becomes a 25% position or a 30% position because it's done so much better than everything else. Like Jack Nicholson said, they can't handle the truth. And in some cases, their grandmothers took away certain body parts when they were 13. So, they're done. Well, it gets to 15% and they trim. It gets to 17, they trim again. And it never gets to even 20%, right? And to me, I really scratch my head about that. So yes, you get a diversified portfolio, but you're cutting the flowers and watering the weeds. And that's not what Rakesh Jhunjhunwala did, and that's not what Warren Buffett did. I think if an investment manager has done the job right, they're going to end up with 80-90% of their net worth in one stock. And the way they should think about that stock. So if we think about the Walton family and their ownership of Walmart, Sam Walton passed away a long time ago. There are no Waltons running Walmart. There might be a couple of them on the board, but they really don't have much influence about the way Walmart runs. But almost all the Waltons are extremely concentrated with 90% or more of their wealth in just one stock, right? So you don't need to be a founder or a founding family to have that concentration. So my friend Nick Sleep, for example, hung up his boots. He had 3 stocks. And one stock, Amazon, became 80% because it did so well and the other 2 weren't slouches, but it did better than Berkshire and Costco. And the way to think about Amazon 80% is the way the Walton family thinks about Walmart stock when it's 80 or 90%, which is you are effectively like the founding family and it's a great business and you just leave it alone. But this is hard. This is hard for most people to do. And I think I have a lot of respect for Rakesh because of what he was able to do on that front.